course on international political economy. Today we are going to delve into a darker side of global finance, financial crisis. Get ready for a roller coaster ride through the causes, consequences, and political economic implications of these turbulent events. What is a financial crisis? Financial crises are like earthquakes in the economic landscape. They are sudden, severe disruptions in financial markets that can spread rapidly across borders, causing widespread economic damage. Think of them as a loss of confidence in the financial system, like a bank run, but on a much larger scale. Financial crisis can take many forms. Banking crisis. This is when banks face a sudden wave of withdrawals, leading to insolvency and a loss of confidence in the banking system. Currency crisis. This occurs when a country's currency rapidly depreciates, causing a loss of value and potentially triggering a broader economic crisis. Debt crisis. This is when a country or company is unable to repay its debts, leading to default and potentially a cascade of financial problems. Causes of financial crisis. Financial crises are complex events with multiple causes. Some of the most common factors include excessive risk-taking. Financial institutions often take on excessive risk in pursuit of higher profits. This can lead to a buildup of bad loans and investments, which can trigger a crisis when the economy turns sour. Asset bubbles. This is when a price of an asset like real estate or stocks becomes inflated beyond its fundamental value. When the bubble bursts, it can cause a sharp decline in asset prices and a loss of wealth. Financial contagion. Financial crisis can spread rapidly from one country or institution to another like a virus. This is due to the interconnectedness of global financial markets and the fact that many financial institutions hold similar assets. Policy mistakes. Governments and central banks can sometimes make policy mistakes that exacerbate financial crisis, such as maintaining overly loose monetary policy or failing to regulate financial institutions effectively. Consequences of financial crisis. Financial crises can have devastating consequences for economies and societies. They can lead to recessions and depressions. A financial crisis can trigger a sharp decline in economic activity, leading to a recession or even a depression. Job losses. Businesses may be forced to lay off workers or close down altogether, leading to widespread unemployment. Poverty and inequality. Financial crises often hit the poor and vulnerable the hardest, exacerbating existing inequalities. Social and political unrest. Economic hardship can lead to social unrest and political instability. Political economic implications. Financial crises are not just economic events, they also have profound political implications. They can shift the balance of power. Financial crises can weaken some countries and strengthen others, leading to a shift in the global balance of power. Trigger policy changes. Governments may be forced to adopt new policies in response to a financial crisis, such as austerity measures or financial reforms. Undermine public confidence. Financial crisis can erode public confidence in governments and financial institutions, leading to calls for greater regulation and oversight. The future of financial crisis. Financial crises are a recurring feature of the global economy. While we can't predict when or where the next crisis will occur, we can learn from past mistakes and take steps to mitigate the risks. This includes strengthening financial regulation, improving risk management practices, and promoting greater international cooperation.